Thank you, Dana. Thank you, everyone, for joining us today. It is my pleasure to speak with you today about the exciting outlook for Adeia. While our name is new, it is built upon decades of innovation and financial success. Before we get into the numbers, let's discuss the underlying drivers that makes Adeia a unique and compelling value proposition. Our extensive patent portfolio is the foundation of our business. With over 9,500 patent assets, it reflects a history of being a pioneer in both the media and semiconductor industries. Over the years, we have successfully monetized these inventions through licensing of our technology to companies large and small, who in turn integrate them into their own product and service offerings. Over the course of the last 20 years, this has resulted in over $9 billion in revenue being generated from our IP portfolios. Being a pioneer and a champion for innovation has long been our core objective, and we continue to invest in order to capitalize on future market trends and technology advancements. As Mark mentioned, there is a proliferation in the use of video. It is pervasive in our everyday lives and continues to expand into social media applications, the automobile, the metaverse, and beyond. We believe capitalizing on this continued adoption will be a key growth driver for our revenue expansion. We also have a long and very successful history in the semiconductor industry. As Dana outlined, the pace at which the semiconductor technology has been able to advance has slowed significantly relative to Moore's Law. Our innovations allow for continuation of further advancements, which address the industry's specific challenges in the march toward deeper submicron nodes. Our financial model provides best-in-class operating results, producing significant operating margins and long-term cash flow generation. This is the engine of our focused capital allocation strategy that will drive long-term growth and maximize shareholder value. Looking forward, we are excited about the market opportunities that will be a catalyst for our future revenue growth. And looking at those growth opportunities, for media, the OTT market is rapidly growing, and we see tremendous opportunities to license our technologies to the providers of those platforms. For traditional pay TV, there are several large Canadian operators which are not under license today. These unlicensed Canadian operators offer us a very favorable growth opportunity. In semiconductor, we see an industry trend of using our hybrid bonding technology for both memory and logic semiconductors. We have seen great traction on the memory side, with approximately 90% of the DRAM memory and 60% of the NAND memory manufacturers under license. While in the early stages, we are now starting to see greater adoption on the logic SoC side at the more advanced submicron nodes. In addition to these areas, our R&D investments will create further opportunities that will help drive our revenue growth as we develop solutions that will expand offerings to currently untapped adjacent markets using media and semiconductors. A very important metric for us is our baseline revenue. Baseline revenue is driven by the recurring nature of our licensing agreements that provide a predictable revenue stream. Currently, our baseline revenue is $375 million, which constitutes the majority of our total annual revenue. Later, we will discuss how this baseline revenue is at the core of our operating leverage and provides strong long-term financial results for the company. As we mentioned earlier, emerging trends within media will offer significant revenue opportunities. This is a continuation of our dedication to innovation and finding solutions for emerging trends. Areas that will drive revenue in the future come from greenfield markets, including gaming and sports betting, ad tech, e-commerce, automotive, and audio streaming. All of these areas are indicative of major shifts in how we interact in our daily lives, as there is a greater introduction of video content in those offerings. Over time, we'll see a shift in our revenue mix as these new media sources will be an ever-increasing percentage of our overall revenue. We continue to expect a decline in pay TV, which will be in line with the overall secular shift that has affected that industry. However, we anticipate that the growth in new media sources will more than offset such declines, resulting in growth in absolute dollars for our media IP portfolio. Now let's take a look at how our licensing business has performed recently. As you can see, for the trailing 12 months ending June 30th, 2022, we recognized approximately $440 million in revenue. Looking at the chart, you will see some fluctuations from period to period that is indicative of both our licensing models and our revenue recognition practices, which I'll add a bit more color to. In general, we enter into multi-year license agreements. On average, our license agreements are more than 5 years. This adds to the overall stability of the company, as well as being integral to the growth in the revenue baseline that I referred to earlier. Our revenue recognition is impacted by both the structure of our license agreements and whether the license is related to either our media or semiconductor portfolios. For example, fixed fee arrangements under our media IP licensing agreements are recognized on a straight line basis over the licensing term. This is due to the implicit need to provide ongoing innovation to our license portfolio for the continued functional use of the underlying applications. In other words, because of future performance obligations, we recognize this revenue over the licensing term. By contrast, fixed fee or minimum guarantee amounts under semiconductor IP licensing agreements are recognized entirely in the period in which the agreements are executed, because there are no future performance obligations for Adeia. As a result of this revenue recognition treatment, there will be fluctuations from period to period, and in some cases, the revenue recognized will be ahead of the amounts billed to our customers. Per unit or per subscriber IP royalty licenses are recognized over time, based on when the related sale or usage activities take place. Our license agreements tend to be quite large and by their nature complex. As such, it can take extended periods of time to negotiate these agreements. A key objective to our overall growth is increasing the baseline revenue amount. That metric reflects overall gains we make in expanding our revenue profile. As you can see, we have been successful in growing this baseline over the past several years. Future growth in the overall revenue baseline will be driven by 1. Continued success of renewing agreements. We have been very successful in this area, renewing greater than 90% of our agreements. 2. Increases in our licensing base from the growth factors and market opportunities within both the media and semiconductor roadmaps. And 3. Pursuing licensing structures that are more consistent with the economics of both parties through aligning revenue measurements and the expected cash flows. This revenue base creates a recurring revenue stream, which provides financial stability and underpins the leverage in our financial model. Our operating margins are impressive by any measure. Our ability to monetize our IP portfolio and successfully scale the business with a disciplined and focused operating structure provides us with operating margins in the mid-60s. What I'd like to point out in this depiction is that the amounts presented reflect projected operating margins using our baseline revenue only. This depiction does not fully capture the increased margins and leverage opportunity of our business, as incremental revenue will have a dollar-for-dollar impact on our operating income. To expand into new markets and to drive revenue growth, we must continue to be innovators. As Paul mentioned, our goal is to increase our patent portfolio by 10% per year, principally driven by organic R&D. With that target, we are making investments in our future with focused R&D spending. This will be our long-term strategy. As such, we anticipate that our R&D spending will increase 10% each year. From an SG&A perspective, we see a more modest growth rate of approximately 3% year over year. This is reflective of disciplined expense management, as it will increase at a lower rate than our overall long-term revenue growth rates. Another component of our cost structure has been our litigation expense. While it is the goal that we amicably reach agreeable terms that are in the best interest of the company and its shareholders, there will be occasions where litigation, as a last resort, will be required to achieve that objective. In 2021 and 2022, our litigation expense has been at a low point, but we anticipate the overall expense doubling in the short term, back to a more normalized run rate. This expense will also fluctuate from period to period depending on our activities. One of our key objectives is to have a focused capital allocation strategy that both drives innovation for future revenue growth and to maximize shareholder value. Our overall strategy can be summarized in 4 primary initiatives. 1, organic investment. 2, strengthening our balance sheet. 3, return of capital to shareholders. And 4, strategic acquisitions. For organic investment, we are committed to expanding our IP portfolio through continued innovation. This will be a key objective which will drive future revenue growth. In strengthening our balance sheet, we will continue to prioritize reducing our overall debt that will remain with Adeia at the time of separation. I will talk about the characteristics of that debt a little later. The company has a long track record of returning capital to its shareholders. We plan to maintain the existing dividend practice which we are inheriting from Xperi, and we will continue to opportunistically buy back shares to reduce the outstanding float. M&A will be an important aspect of our growth strategy. We will be disciplined and focused in identifying opportunities, both big and small, that are adjacent to or complementary of our core offerings. Focusing on those opportunities that will accelerate our development roadmap or that can add to our overall portfolio to drive incremental revenue growth.
At the time of separation, Adeia will have between $75 and $100 million in cash on the balance sheet, and we will assume the existing term loan balance, which is expected to be approximately $760 million.
The term loan, which matures in 2028, is a variable interest rate loan at LIBOR plus 350 basis points. For the terms of the loan, there are mandatory payments and excess cash flow provisions based on our debt leverage ratios. The timing of the payments can greatly impact our overall cash position. As an example, we estimate that the annual excess cash payment due in Q1 2023 will be approximately $85 million based on our current forecast. While using a balanced approach with our other capital allocation objectives, we will look to accelerate paying down of our debt to reduce our overall leverage ratio and excess cash payment requirements. Additionally, we will explore financing alternatives in light of the market conditions. For our financial outlook on a standalone basis, for the full year 2022, we anticipate revenue will be between $425 and $450 million. We anticipate total non-GAAP operating costs and expenses to be between $140 and $150 million, resulting in a non-GAAP operating margin in the mid-60s. Long-term, over the next 5 years, we expect revenue to increase by a CAGR of 6% from our full year 2021 amount of $391 million. As part of our long-term objective to continue our innovation strategies, we anticipate total non-GAAP costs and operating expenses to increase by a CAGR of 6 to 8%. As a result, we see our long-term operating margins in the mid to high 60s. As you can see, there are exciting opportunities that lay ahead that will drive our revenue growth story. Coupled with the leverage that our operating model provides, Adeia is a unique and compelling story. With that, let me now turn it back to Paul.